So sort of a part two of yesterday's video looking at the stock side. This is the ETF side. So if you haven't seen yesterday's video, I'll put a link in the comments. This is sort of my long-term, I'll call it watch list. I do have some of these, so no sort of S&P 500 tracker still, or the mid cap that I've been looking at. Still think they're a little bit overvalued. I do have the small cap value in the trading 2-on-2 account. Still sort of wondering, doing a little bit of research on when I do get the S&P 500, whether to do equal weighting, so sort of 0.2%-ish in each company rather than market cap weighted. Obviously, you'd be a lot less weighted on the sort of tech, the FANG stocks, but yeah, long term they seem to sort of do reasonably well. So yeah, the still sort of that's the current watch list. The small caps I don't have at the moment. The gold and silver, I've still not really got on board with sort of having these as ETFs. I sort of picked a few companies that I preferred out of all of them, and that's my gold and silver side. Emerging markets I do hold, but needs to increase that position, and same with Japan, really. Europe, I have the Europe mid cap, but not the small cap value. And then I've got these three. I did swap the iShares water for the legal and general water. So yeah, that's sort of current watch list, if you like, of ETFs. And sort of on the more bearish side, if we go that way, I'd probably be considerably upping the sort of weight of the S&P 500 and probably sort of going for a NASDAQ 100, assuming the tech stocks do get hammered. And I think maybe with sort of 5% between the two, sort of have a little bit of a dabble in the leveraged ETFs. Not 100% sure whether I go for 2x or 3x. Obviously, 3x is a hell of a lot more risky. And but with 5%, I don't think that's too bad. Maybe something you can sort of average into, not trying to time the bottom. Sort of go a little bit cautious, and then if you miss the bottom, just leave it and see what they amount to. So yeah, interesting sort of look at those. I haven't picked one specifically just yet, but sort of see how it goes. Keep the world small cap ETF. I'd look to be going into that. Small caps would presumably get hit quite hard. Gold and silver, I think I'd probably drop the gold side of it and maybe go a little bit more heavy. Maybe go for the ETFs rather than the individual companies that I've got, and go all silver. So I had 5% in the gold and silver overall with these ETFs. I think I'd probably go 5% still all in silver, with the sort of, it'll probably get knocked hard in a crash due to the sort of reduced industrial demand. So yeah, go for silver reasonably heavy. Stick with the heavy emerging markets. Do sort of like that going forward with the sort of demographic tailwind, if you like, sort of middle class growing with sort of China and India and places like that. You sort of got a hell of a lot of people potentially coming into sort of reasonable levels of income and sort of spending money within those countries. So yeah, I think that'd be one to go for. I think I'd probably drop Japan though. Never been that confident in Japan, but just have it as a bit of sort of diversification. But yeah, I think if we crash and everything's sort of low down, not necessarily the same sort of PE ratios and forward PEs, then I think I'd probably drop Japan. Similar with Europe, really. Even the sort of small cap value. Europe one, I'm not sure I'd really go for. if everything's down. And then my thematic ones, so I think I'd probably drop the water. Not one that I don't think would sort of rocket up in a crash, so maybe one I'd sort of get out of. And this sort of Doomsday ETF list is really for probably a year, maybe two, just sort of seeing how we come out of the crash really, and then maybe I'd sort of slim down on some of these again and go back into things like the water ETF. But yeah, so you'd keep the global clean energy and video gaming, both sort of could get whacked in the crash, and I'd sort of feel long term should do well. So I think even in the short term they would do well as well. So keep those. And the two sort of thematic ones I would add, Scottish Mortgage do seem to sort of be able to pick reasonably good sort of stocks. It's just a global investment trust with a active fund manager. It's not really thematic as such, but they do sort of go for seemingly a lot of Chinese tech and that sort of thing, but they pick the individual companies, sort of heavier weightings necessarily than just what the market cap would offer. And then some US sort of growth stocks and that sort of thing that I don't really know a huge amount about. So yeah, I'd probably go for that. And the iShares or Legal and General robotics. So you sort of notice some quite into the automotive industry, whether that's a good thing or not. But I think whoever sort of wins or whoever sort of comes out on top, they're all going to be either building new factories or revamping old factories and that sort of thing. And just think that's just one sector that's going to be sort of wanting a hell of a lot of the sort of robotic, automated building machines and that sort of thing. I haven't really found an ETF that focuses sort of entirely on that sort of thing. Even the sort of iShares and Legal and General robotics are sort of on the fringe of those types of companies, whether those companies aren't public or just sort of not really available, I don't know. But sort of some of them seem to have like Nvidia and AMD and that sort of thing. I just think it's not robotics themed. It's just companies that might have an exposure, where if you're going to pay an active sort of expense ratio for the fund, a lot of them are sort of 0.6% to 1%, then I would really want it focused on sort of the actual theme that they're trying to go for. So yeah, might have to look a bit more into that, but certainly one I'd be looking to add to. So yeah, this is sort of roughly, obviously it's not 100% going to be this, but this is what I'd be sort of considering if we get a downturn. And then judge each one by its merits at the time. So as I say, this would probably be something I would stick with, maybe hoping for a sort of a more V-shaped recovery out of this sort of thing, when people realise the companies aren't going bust, so they want to start rebuilding up growth stocks and that sort of thing faster than maybe some of the value names. So yeah, maybe keep it for a year or two. And then if we sort of get a strong move out for these stocks and they start to become sort of reasonable, if high valuations, then we sort of go back to more of the target allocation ETFs. So yeah, that's rough sort of plan at the moment. Always changing, always fluid. So yeah, leave your thoughts in the comments below on both videos really, and like and subscribe. See you soon.